let's review a few charts in the middle of the week. Hi, I'm Nick. I'm back at my desk, finally. It is Tuesday night, doing homework for us, and I'm going to start with my plan of action. So what am I doing at these levels? I'm going to break it into two separate pieces, and also hang on until the end. I have something important to say about the IWM. You don't want to miss that. First things first, what am I doing in this market? I'll tell you from a trader's perspective, it's pretty good because things are moving fast and crazy in both directions. If you're a good trader, you know charts, and you're in the live room, come join us. We can trade the hell out of this market. That's the first piece. The second piece, if I'm an investor, let's say I just came into money and I want to deploy it into the stock market. When it's at all-time highs, it's not the best idea. It is, as I call it, NOPE, N-O-P-E, not an obvious point of entry. If I see a stock that's falling, like it drops 20% into support, I may be convinced to deploy some money, but a starter position. From an investment perspective, I'm holding back. I'm not selling puts naked. Now let's talk turkey as far as charts. You're looking at the S&P SPY. These are lines that I've drawn in other videos, hand drawn. You can see the aqua color. That was the breakout from 460, the zone of 460-ish. And this was the target. They're halfway through. They overdid this first leg. But now if we check back just to the breakout zone, it's about a 10% correction. I will go next to the QQQ, and then I'll jump right into the IWM as I promised. But before I forget, if you like the content, like the video, and comment. Let's debate it. If you have other ideas or you see something I don't, let me know. And if I'm missing something in the content, let me know so we can do better, make it more interesting. This is the Qs. They had a bad day on Tuesday, I think the worst of all of them, and it's just reverted to the mean. Look at the lines on my screen. They overdo it, and they revert to the mean. Circle, mean, you can see them, the red line in the middle. So even if they drop another 2 to 3 or 4%, they would be just traveling inside this ascending channel that has been inside the bull's hands. And this is where I'm taking you to the IWM in a minute. These are extreme conditions. Extreme conditions, by definition, don't last. Otherwise, we wouldn't have a different word for it. It'll be just normal. It'll be normal and normal. It wouldn't be normal and extreme. And here's the IWM. As I promised, I hand drew these yellow lines. Let me explain what I mean. This hand-drawn path is a potential that the bulls would definitely want to avoid, and I'll tell you why in a second. I know there are sellers inside the aqua box. We've been watching this zone for 2 years. Here's the statement. If the IWM doesn't break out from this zone convincingly, even if it pokes to 208 or 209, if they don't close convincingly on a weekly basis, 206 to 209, they're in danger of drawing my yellow path, which means coming down to 198 or 199. And I'm saying that if that happens, they're in danger to following down to below 190 and maybe even 179. So below 190 is like a 10% correction. And then you can do the math down to 179, which would be a full-blown recession, 20%. So I'm not calling for a recession. What did I start the statement by saying? If they don't convincingly break out, if they don't do it, and especially if they poke and come back, I think the yellow line will come to fruition down to below 200. And if we do that, we can start a lower low and lower high, drifting lower into those numbers I told you. All right, so I'm not a full bear. You know me, I'm bullish. I just want caution from both sides. So both sides are emotional. So use charts and lines, you would do better.